Well, hello there, everybody. Michael Silva. How will the stock market respond to the jobs report? We got some macro data coming out, non-farm payrolls, unemployment. That's what we're going to be talking about on today's Stock Market Brief Show. Welcome to the show. If you're new here, make sure to hit that thumbs up and subscribe if you like technical analysis and digital market analysis. We're getting right into it today. Phew. So, how is the market going to respond? We're going to talk specifically about what the market is pricing in based off of implied volatility. We're going to be looking at those expected moves. We're going to be looking at some other indicator charts, and I'm going to give you a couple of thoughts along the way. So, jobs reports coming out tomorrow. Consensus, 250K. The previous, 315. An easy way to think about kind of like what may take place if you really want to act quick, and I'll tell you what I'm going to do, but bad jobs report most likely is going to be good for the market of how the Fed is going to have to respond to that. A good jobs report could be potentially bad for the market because of the way the Fed's going to respond to that. Now, I want to show you an interesting chart here. This chart you may have not seen before. It's known as the S&P 500. Now, okay, let's keep talking. These blue lines on the screen represent the last 4 job report dates, right? It's typically the first Friday of the month. So we're looking back at the first Fridays of those months. And the thing is, can it have a big impact on markets? Yes. When we look at, like, when we say that, though, a lot of people think, yeah, it's the S&P 500. Typically, these type of reports have bigger impacts on the dollar. It has a bigger impact on the yields, so the bond market. So that is what we're going to have to actually pay a little bit more attention to. When I look at the S&P 500 and you take a look at these days, not much happened, but we did see obviously some increased volatility, but not too much, okay? Let's take a look at the dollar. The dollar started breaking out today. Is this telling us a little bit of a heads up? When this report comes out, this dollar is going to go screaming higher, and that's going to bring the market down. Possibly, right? There's a big negative correlation between the dollar and the S&P 500, and not just the S&P 500. It has a negative correlation with various commodities, just a bunch of different stuff that it's correlated negatively to. The 10-year yield, right? This is also fired off today a little bit. These last couple of days, a big shot up, right? It came down. Everyone's like, haha, I told you the peak is in, and then all of a sudden, 2 days, it comes right back. We'll see here. My take on all of this is to let the market digest the news, right? So the event, by the way, it comes out an hour before the market opens. So 1 hour before the market opens, this report will come out. So leading into this report, what do? I de-risk my portfolio. I take risk off the table, right? Because it could be very binary. And how the market responds, we need to let the market digest in order to feel a little bit more comfortable putting more risk out on the table, given the sense of volatility that we're currently seeing. And we'll talk more about that. If you take a look at the bonds, TLT, geez, this thing keeps on getting just completely destroyed. We'll continue to watch this. Maybe it's forming a bottom process. Yeah, we thought maybe it was forming one here. As it stands overall, we're still in a downtrend. Lower highs, lower lows. We'll wait for that to change. It still hasn't. If we take a look at HYG over SPY, this is the smart money versus the dumb money over here. We do have that negative divergence is playing out so far. We'll see if it breaks down further and we can make a little red box around it like this one over here, but we'll make it over here. So that is a negative sign, would be positive if we see HYG, right? Jobs report affects the bond market and the dollar quite a bit, okay? So what would be positive would be seeing HYG break this divergence, even if the SPY comes down at first, because if HYG starts taking off, that might give us good insight that, hey, the SPY might follow. So be on the lookout for that. Now, what I really want to hone into, because a lot of people are going to be focused right on this report, rightfully so, but next week we have a lot of data drops too, okay? So you got to be patient here, right? There's going to be, these are huge reports. We have core inflation, we have FOMC minutes, right? And PPI. So that's the 12th and the 13th, and I highlighted it on here, right here, these little bars, minus this, that one right there. But these pink bars over here, this zone, that is when that data comes out. And now the reason why I'm showing you this and why I find it interesting is remember this run up right over here into the middle of May. Boom, we saw this run up and it went sideways. We got that report, and then right here it started selling off into the CPI report, and then the CPI report came. Well, we're seeing something somewhat similar where we're getting a pop up, right? Overextended to the downside, we got a rally. Overextended to the downside, we got a rally. So if we just get some kind of lackluster day, which by the way, we're going to go over the ranges of what to expect, be aware that the real volatility could come when that CPI report hits the tape. Now, remember, the CPI report, we'll look at core inflation right over here. Inflation rate year over year. Let's take a look at that one. Inflation rate year over year, consensus is 8.1%. The forecast model currently for trading economics or trend economics or whatever it's called is 8.2. Okay, I have seen other models that are 8.3. So you got to understand this whole Fed pivot narrative. I feel like it's already being priced away, but if inflation comes in hotter than expected, watch out, right? Because we've seen what happens, right? It gets very wicked inside of these markets. So we will pay attention to that when the time comes. Another thing to pay attention to during this process of why I'm bringing this up now is look at the CRB index. It's up 5.5% basically this week so far. So this is not good to have take place, right? Led by energy. Energy names continue to kind of move higher. And I am still looking to build into a short position, but as it stands right now, I have a very small short position. And today I even mentioned to the Patreon, I'm like, I'm gonna step off of this one a little bit. I'm gonna keep it at 100 basis points until I can see some maybe price weakness, because just behind the macro data, OPEC plus, all this other stuff that's going on, I don't want to walk into a freight train right there. So I'm being careful. All right, but this right there, that's not a good sign if this starts breaking out further for inflation, okay? So those are a couple of warning signs, but let's get more specifically going into tomorrow. On a positive note, we are above the 5-day moving average on the S&P 500, and it is inclining. Clap, clap, here we go. That's good. Okay, what is the options market pricing in as far as an expected move? Holy moly, it's pricing in a plus or minus $6.1 move, right? And that's, it's like I said, plus or minus. So it's just giving us a range. Where's that range? Well, the range could take us potentially back into the weekly expected move, or it could take us to about the high of the trading session right over here. I think that was October 5th, okay? Now we are, I anchored this VWAP right here. This is the month to date, week to date, quarter to date anchored VWAP, and you can see the SPY is actually acting very well on it, right? We broke out, we pulled back to it right here, we pulled back to it again, we pulled back to it again, and now we're sitting basically on it. So if price gets under this, right, and it kind of looks like this topping type pattern, right, lower highs, and it's just basically barely holding on, if we start breaking down, it's likely to come test out into this area, which would mean what? It means price could very well cut right through the 5-day moving average, but you never know. We could have somewhat of an undercut like we've seen prior, and if this trend still continues up, you wait for the U-turn if you're bullish, and you might be able to buy back on the way out or when it recovers this anchored VWAP, okay? So that is something that I'm trying to pay attention to, but you could potentially fade very strong moves into either end of this right here. So once again, it's plus or minus $6 move. So that's about 2% on each side, by the way. It's not a small move. These are huge moves in the market. Okay, yeah, 2% up to this way, 2% down to this way. And let's take a look at the Qs. The Qs is pricing at $5.4 expected move. Once again, that's plus or minus, and once again, we are above an inclining 5-day moving average. That's positive. And then here's a good example of how we have that anchored VWAP to the month to date, quarter to date, week to date, how we got that undercut, right? It didn't act as nicely as the SPY, but it undercut, came up back through. And what's nice about this is if you bought back up through this, right? Not to say that this is the greatest setup right here, but if you did buy back up through this, it would allow you to at least have a stop loss right under that inclining short period time inclining 5-day moving average, and you could have caught this move and you'd still be potentially in the trade with maybe a stop, or right here right now, which looks like it'd be about to get stopped out. We're not far off the weekly expected move right here. And the expected move for going into tomorrow's macro data report, which is important to know because remember, the market could respond to one of these levels before the market opens. And the reason why is because the report drops an hour before the market opens. So pay attention where the market opens. If it opens down here, we might say, okay, price is, done for the day. Now, if it opens up here, okay, we might be able to fade potentially that because prices reach its high of the day. Now, I want to preface this to be very careful. There's a couple of things that I want to be very, very mindful of as far as risk from both, upside and downside. One, we're already trading outside of the weekly expected move. When we get outside of the upper weekly expected move, right, dynamic hedging has to kick in. It's always kicking in, right? But when we get outside of it, what happens if we start falling back in it after all the new hedging took place up here? Well, it can unwind itself probably very quickly. All right, so we've been seeing this year, multiple breaks of weekly expected moves. So if we get some dramatic action in the markets tomorrow, who's to say that we can't see a 2 sigma move, which is basically double, so $10, around a $10 move in the Qs. And that's just the thing. We got to be aware of the potential risks that lie ahead. Now, if we just come right back in the weekly expected move, that would make the second week in a row where we closed with inside of it. Last week, we didn't even test the edge of expected move, and now we're trading right outside of it. But it's in bullish context. We have the month-to-date, week-to-date, quarter-to-date VWAP. We're above an inclining 5-day moving average as well. So this is actually more bullish in the very short term. In the long term, when you zoom out and you look at the trend, it's a different story. And when you look at things like the HYG, smart money versus dumb money, right? I hope you get to see both sides of how it could be potentially bullish in the short term. But hey, there's some other negative headwinds. Yeah, obviously. So that means what? We got to manage our risk per usual. IWM, also very same situation here. We are above month-to-date, quarter-to-date, week-to-date anchored VWAP, and you could see you turned it, right? It came back in, came right back up, could have made for a good trade. Actually, I did trade this. I actually played the move to the weekly expected move right here, and that's when I covered. And look at how it flipped, right? It basically broke outside of it, acted as an area of support in confluence with this anchored VWAP, and now we're trading above that and above an inclining 5-day moving average. So if you're looking at this, you'd be like, well, it's actually kind of just, I don't know, maybe it's a diamond pattern top, right, where it comes back down into this range or retest the lower expected move. Sure, obviously that's a possibility. So these are just the areas that I'll be watching for coming into tomorrow's trading session and see how price responds around there, plus or minus $3. I'm just gonna say $3.50. Now I want to be very adamant, I guess, when I point this out. Volatility closed once again. The VIX, volatility index, the VIX. Boom, 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 closed at 30.52. It's in the 30s again. So that right there is, we're looking at a plus or minus 2% move. So huge amounts of volatility. Once again, this is where crashes can happen. This is where some crazy stuff can happen, right? If volatility holds up here, we may see some crazy things happen. We have not seen anything really all too crazy happen as far as a capitulation type move. It's been quote unquote orderly for the most part. Russell volatility, it's at 35.91. This is not supposed to make you feel good as volatility kind of just hangs out in this level where it could potentially very well fire off at any time. Same with NASDAQ volatility. It closed at 35.84. These are warning signs. Remember, this is not to say the market's going to crash, the market's going to rip. This is to say you do not need to execute with large amounts of money into this to have a decent size gain, right? Once again, if you look at it from the standpoint of the VIX, which I say multiple times, if you are used to investing into the below 20 range, okay, and you say you have a $100,000 portfolio, okay, and that's what you were used to was here in this zone on the prior years. Well, what happens if it starts trending up here? Well, that same $100,000 is almost worth 2 times. Now, it's the same dollar amount, but the volatility is just about doubled. So it makes, if you have $100,000 on the table right now, it's going to be moving back and forth as if you had $200,000. Okay, does that make sense? I hope it does. Volatility, you need to adjust your portfolio for volatility. You got to be careful. This is where fortunes are made, but this is also where fortunes are lost. Let's take a look at the summation index. It's starting to curl back around. Parabolic SAR is still above it, waiting for that click over. Looks like it might happen. Understand that we do have whipsaw type events that occur, but overall, it's been a fairly accurate indicator of when we should maybe potentially position ourselves a little bit more long, not just based off of this indicator, but you also want to look at price action. Spring bottom fish are starting to curl back up. It's below the 30 marker. Wait for it to cross the signal line. Wait for the green line to start curling back up too. That give us also a little good indication that we may be seeing somewhat of a short-term bottom, maybe potentially long-term. I don't know. No one actually does. You can be confident. You can be whatever you want to be, but it's not going to be a guaranteed signal by any means. Last thing I want to talk about is SPIP over GOVT. Why does that happen? Why? Whatever. It's happened like the last 3 shows. So basically we have tips over treasury bonds when we apply a rate of change. Down here when the green line gets triggered below -2%, volatility subsides, and you can see here volatility, it's taking a little bit of a back seat. Here's the problem. It doesn't tell you how low it's going to go or how long it's going to drop. It just tells you, hey, volatility might subside. And, well, last time it triggered was over here, and it subsided for quite some time. Okay? When it gets up to in this 1.3 range, it says, hey, warning, right? Volatility may be just around the corner. The last trigger on the volatility spike was over here. And hey, what do you know? It ripped up, okay? So it's been a very accurate indicator so far, but it's not a holy grail. Nothing is, okay? And it doesn't mean that this has to come up here in order to see volatility rise. I want to be very clear, as volatility kind of looks like it's like flagging over here, like it's getting ready to fire off, okay? If this was right here at this current time and this line was up here, I'd be even more warning. But as it stands right now, we're just hanging out. It's a very, interesting time. We looked at the implied expected moves. Once again, $6 for the SPY. We got $5.50 for the Qs. IWM is $3 and about 50 cents, right around there. That's where I'm watching going into tomorrow's trading session. Hope it gave you some insight. That's all I got for you today, everybody. Silva out.